Acknowledged? Yep. Okay. Um, so look, we are in, the throes of winter on its forefront. That's the worst time in the purchase market cycle at a time when rates are scary high to many, and the media is not our friend. And so all I want to do today is I want to walk you through an argument that I'm going to make. You can take it or leave it. You don't need to make screenshots. It's being recorded. I'm going to send the deck to Kathy when this is over so she can distribute it. So don't worry about any of the slides. You're welcome to use them if any of them are worthwhile to you. But I really believe this is a time when leadership is determined, and unfortunately, we're not going to get market leadership from external sources, right? Just look at yesterday, where the Fed's messaging confused the market, rates began to rally, stocks went up, then Powell comes back and changes the message, and the market moves the other way in the afternoon. You get notices to lock and everything else that come upon you. This is a very unpredictable market, but we're all in sales. Anybody here in origination is in sales, and maybe that's a bad word, but you're in the position where you can provide leadership in your community to your sphere of influence that you use as sources of business and have relationships with realtors, home builders, financial planners, whatever it may be. So I'm just going to make an argument about why I actually think this winter may be one of the most unique buying opportunities that we've seen, definitely in the last couple of years, but more so in many years. And I'm going to argue it along these lines. One, I'm going to talk a lot about rates. I want you to understand why I think rates are coming down. I want to highlight why the core fundamentals of this market don't compare to any other sort of recession you guys have experienced, especially the housing crash of 2008. We have, between inventory and demographics, this is just an incredible force. I'm just going to walk you through some fresh data that I pulled off of a couple of key resources today. I want to emphasize the fundamentals of home ownership, and then I just want to close again with where I think I would be headed if I was a loan officer. Jake, Steve and I were on a call, I don't know, 2 weeks ago, I don't know when it was, with a team from Fairway. And at the end, we both talked about our upbringing. We were fortunate because when we started as loan officers, I was 83, he was 84. Interest rates were in the mid-teens. There were no refinances. Nobody was refinancing into a 14.5% interest rate. That just wasn't there. And a lot of loan officers were just scared and lost about how to survive in a market like this because they still were holding on to their 6 and 7% rates from the late 70s and couldn't get it out of their head. We were just dumb enough not to pay attention, went out and made calls and got loans. But unfortunately, I think what we're coming off of here is a very different environment that in essence spoiled the industry. 2% interest rates can do that to you. And all I want to emphasize here is this is the most fundamental paradigm shift we have ever experienced in our business since any of us have joined it. So let's go with a few perspective points.
Okay,
first of all, rate.
Before you start, I wanted to share this because I know we got some realtors listening too. This industry, having started in 84, and you and I both talking about originations back in the 80s, one of the things that when this happens is the time that loan officers can go and share and educate agents on how to use financing to help sell houses. The 2-1 buy down, what we learned, nobody wants 13.5%. Nobody wants 12.5%. No matter what the rate is, everybody wants a deal. So a 1 buy down, a 2-1 buy down, that is a deal. It's different than the fixed rate. So don't be discouraged because the rates are what they are. Know the consumer's mind. There's going to be buyers that want to buy, but every buyer wants something special. Something special is part of educating the agents and how to have the financing work for you as agents to help sell more property. So keep rolling.
Yep. And for all you realtors out there, part of my career, I was the president and chief operating officer of a big real estate company called Long & Foster. You probably heard of them if you're in the business. They were a huge, large, privately held real estate company. We had about 14,000 agents. I used to do this kind of conversation with them because we constantly need reinforcement and ideas. And that's all this is about today. So first, let's start with rates. You've seen slides like this before. This is the history of 30-year fixed rate loans, comes off the Federal Reserve's own website called FRED. It's come from the Federal Reserve of St. Louis. Takes us all the way back to 1970. And all I want to emphasize is to all of you is a 7%-ish rate is a really good deal when you look at it historically. In fact, if you look what's below the red line, kind of below where we are roughly right now, the only time we've really hung out below that line for an extended period of time was during the Great Recession of 08 and moving forward. And that's when the Federal Reserve stepped in with 3 rounds of quantitative easing, meaning they bought mortgage-backed securities out of the market. That created a short in supply, drove prices up, yields down, and that got us through that period. And then we had the pandemic recession. And in 2020, the Fed did the ultimate big short, the ultimate quantitative easing, and that drove rates down to 2.25 range. That ain't going to repeat itself. I hate to say it. I think we'll see rates slow down. I'm going to show you why rates are artificially high right now, but we're not going to see 2.25 again either. I think we have to stop looking our wounds around 2.25, and we have to start saying, look, rates today are still near historic lows. They're extraordinarily low when you take historical references in play, including the roles of quantitative easing. And with Jake's point around using buy downs as an opportunity, I just think you can give people a really good opportunity to get in at a good rate in the 6 or the 5 range. And by the time it adjusts, I believe rates will be lower. I'll show you why that is in just a moment. I'm going to do it with data. I'm not going to do it with conjecture, but we have got to stop just, wishing for the 2.25 rates of the past. That was in a pandemic recession, and previously the worst recession since the Great Depression. And all I would tell you guys is we're not going to repeat that anytime soon. Just look at the unemployment numbers and the employment numbers, both that are coming out. Employment's tomorrow, but it's just going to be, these are big numbers. The economy is hot and fire. But I want to give you perspective, all right? So this is the history of mortgage volume. It correlates to real estate sales, and I'll show you why. This is total mortgage volume going back to 2002. The gray bar is total volume. I'm sorry if you're hearing a buzzing in the background. My landscapers are here. Bad timing for me. But the gray line goes back, is total mortgage origination volume. The blue bars are purchase volumes, and it takes you out with a forecast to 2025. The orange bars are refinances. So all I want you to do is look at the gray bar first. Look at total volume. This year, we're going to do about $2.2 trillion in mortgages. The forecast for next year is about a 10% reduction to $2 trillion. And for realtors, look at the blue purchase bars. You can see it's really going to remain relatively flat in the purchase market. We're just going to have a continued reduction in refinance volume between this year and next year, and that's what brings us down. But then I just want you to take your eyes to the left, where I drew that red horizontal line all the way back to 2008. A total mortgage market of a little over $2 trillion is historically, going back to 08, which is 14 years, a better market than we basically saw any time in that last decade and a half. So even with the market contracting and going to contract a bit more likely next year, because we won't get rid of these higher rates until the second half of the year, most likely, we're going to see just a slowing market. Now, I do want to show you the forecast going forward. And this is by Mike Fratantoni, PhD economist from Johns Hopkins. But his forecast is 2.3 trillion in volume in 2024, 2.4 trillion in volume, almost 5, all because of increases in purchase activity in the out years. And I'm going to show you why that is believed to be happening as well. But for mortgage guys on the call, let's remember where we're at. The reason why we are feeling the pain as mortgage originators is, yes, the market's smaller than it was the last 2 years, but 2, we just haven't right-sized yet. I mean, National Mortgage News published a story on October 24th that the mortgage industry needs to shed another 25 to 30% of staff. And, gang, I really think this is an interesting time for all of us, because If you look at the left graph that goes along with this story, all it shows is the orange line is mortgage production. The blue line is employment in the industry, and production has dropped faster than employment. For me, I think it also bodes a real important obligation for good companies like Fairway to make sure you have a really strong relationship with your real estate agent partner, because we're seeing companies shut their doors, right? The one in Kansas City that's been around for decades that shut their door yesterday. I'm not going to name other company names, but it's happening literally in front of our eyes. And the last thing you want is for a potential home buyer to be in the process of taking a loan application only to have their company closed down. And the thing I really appreciate around the company that Steve Jacobson has built is he doesn't have Wall Street parents. He doesn't have shareholders. The company's having a really amazing production year, is growing with origination staff. And you just don't have the headaches that a lot of these other companies, particularly those that went public in the last couple of years, have. And so you're going to be one of the surviving firms as the industry sheds. And as it sheds, we're going to right size. And I want to remind you guys, if you started in the business after 08, which is most of you loan originators here, you had some really good years over that next decade plus, not just the last 2 years, but that whole entire period. You had margin in your business. Next year is going to be bigger than almost any year of the last 15 years, other than 2020 and 2021. And yet you're worried. And the only reason you're worried is we have not yet right-sized. And that's going to happen. It's happening now. It'll happen through the rest of the winter. And so I really believe the light is at the end of the tunnel. Shift. I want to shift to rates. And I want to talk to you about why a lot of folks, not just the MBA's chief economist, but Lawrence Yun at NAR, the Home Builders National Economist, folks at CoreLogic are predicting that rates will go down. There are some contrarians to that, and I think they're wrong. But there are a lot of predictions that will be down in the mid fives in the next year. And I don't want to get in a debate with you guys about this. I just want to show you numbers and let you come to your own conclusion. So it's just the next 2 slides. Bear with me. This is the federal funds rate going back to 1955. And as you know, the Fed made their move yesterday by another 3/4 of a point. So all I want to emphasize to you is every period after the Fed quantitatively tights, it's called quantitative tightening. Quantitative easing is when they buy treasuries and mortgage-backed securities and rates go down. Quantitative tightening is the alternative to that. They stop buying, which takes out the biggest buyer in the market, and then the supply rises. Prices go down, yields go up. That's what we're in right now. But after every one of these quantitative tightening periods, we see a recession. Maybe short ones. You see it. The pandemic recession is that gray line sliver at 2020. The Fed was actually raising rates just prior to that, to the pandemic. And then suddenly the Fed jumped in and did a big QE move. Go back to the 2008 Great Recession, that gray bar just before 2010. The Fed was actually relieving some of the purchases they had made over a previous period. And the Fed funds rate was rising, but then the Great Recession hits, the world economy is coming to the throes of near collapse. And the Fed comes in, not just with 1 round, but 3 rounds of quantitative easing. You could take that back to the dot-com boom and then the recession, the oil patch crisis. You can take these through the 1994 recession, which we saw 150 basis point spike in interest rates in 3 weeks in the spring of that year. But every period after that, we see a slowing of the economy and the Fed fund rates start to drop again. And we're on that verge now where you see rates rising. So why am I so certain rates are going to drop behind this? Other than that, they've always done it, going back to 1950 to the 1950s. Every one of those gray bars is a recession, always after a period of Fed fund tightenings, and you always see a slope down in rates after that recession begins to hit. So I just want to highlight that to you. That is going to happen again. You can say it won't, but you'd be defying our entire history of the financial markets going back probably long before most of you were born. So I want to give you the reason why. I'm just going to show you 2 slides. You got to bear with me. This is the most complicated part of the presentation, but I just want you to understand it. fixed rates are abnormally high last year. So I pulled this off of Black Knight. Most of you in the finance business know who Black Knight is, but they put out great research. And all this shows you, and bear with me, the top dark sort of greenish line is the 30-year mortgage rate going back to 2010. The blue line, the bright blue line below that, is the 10-year treasury yield. The gray line is the average spread between those two lines. Now, all I want you to do is look at that gray line going back from 2019 to the left. All that's telling you is mortgages forever have typically laid around 1.5% to 2% over the 10-year. That's been the spread, and that's what that gray line says. You can see the vertical axis on the left, that's percentages, and it shows you that the average spread between 30 years and 10 years is about 1.5% to 2%. But until you get to the far right here, suddenly the yield curve has widened, right? The 10-year has the delta between the 10-year and the 30-year is now 300 basis points. In fact, the 10-year today is right around 4%. 30 years are right around 7%. We're sitting with rates at roughly double what they normally sit at over the 10-year treasury. Why is that? Very simple, guys. A lot of people aren't buying mortgages, and they're not buying, it's not just the Fed. Traditional investors aren't buying 30-year mortgage-backed securities because why? They know they're going to prepay really quick because rates are going to come down. And because of that, they'd rather put their money in longer term duration assets that they can match better rather than the unpredictable hot money asset, as we call it, which is a mortgage-backed security. And because fewer buyers are buying mortgage-backed securities, the prices of those, the remaining supply is dropping even further than normal, and yields are going up higher than normal. And that's widening the spread to 300 basis points is a complete anomaly. So all this screams to, in short, is the market knows rates are coming down. So people aren't buying these 7% mortgages because they know they're going to prepay super fast, and they can't predict what we call duration. I'm going to give you the same story that tells the same thing, but in a different way. The 10-year treasury security, this is just treasuries, not mortgages. But if you look at the 10-year versus the 2-year, and this is just the spread, normally the 10-year is above the 2-year. Normal yield curve means that 10-year treasuries will have a higher yield than 2 years because shorter yield treasuries earn less versus longer yields. But that's inverted. Suddenly, if you look to the right here, the yield curve is inverted. It says 10 years are roughly 50 basis points cheaper, lower in rate than a 2-year. So you can get a higher yield on a 2-year treasury than a 10-year. Why? Because global investors are rushing to buy long-term treasuries. And why are they doing that? Because they know even though it's inverted and the 10 years at 4, which is a lower rate than the 2-year, that it's still locked in for 10 years. And I know rates are going to come down lower because that's what happens after the Fed finishes its tightening. And I'll take the long-term duration of the 10-year. So we have massive global interest from the Bank of China and the Central Bank in Ireland and the Bank of London, and all of these investors globally that typically buy US currencies are rushing to buy treasuries, not mortgages. And so look at this. They're buying treasuries even though the yield is inverted. Long rates are lower than short rates because they know even at that inverted rate, they're probably going to go down lower, and that will include short rates as the market slows. But in mortgages, long rates are higher than short rates. 30 years are above the 10-year. So all of this screams to any analyst who looks at markets, rates are coming down, gang. And all you have to do is take the treasury today at 4%. Let's suppose it even stays there at 150 basis points over 4, which would be a normalish spread. That gives you rates at 5.5. But the reality is 10 years are going to drop below 4 because the inverted spread of the treasuries tells you they're going to drop below 4 to get back to a normal curve. Look, I know this is a little technical, But trust me, these aren't people betting on this. These are people looking at market conditions and yield curves, and they know damn well that the market is screaming rate drop, and that mortgages right now are artificially increased, which is why I love Steve's approach of using a temporary buy down to get you till the rate drops, which it's going to do. Another way of looking at it, one last picture. Normally, 30-year fixed rate jumbo mortgages, they typically run, this only goes back to 2011, but they typically run, as all you loan officers know, around 0.25% higher than a conventional conforming 30-year fixed rate loan. Well, right now, jumbo 30 years are lower in rate than conventional conforming. Why? Because jumbo loans are sold to banks. Banks originate them and hold them in their portfolio. They are the buyer, and they're buying all of it. They have all the demand. They're not trying to pool and sell them into mortgage-backed securities and depending on global mortgage-backed security investors who are just not that there aren't enough of because they think they're going to prepay quick. And so the yield on 30-year jumbos that banks demand over their cost of funds just gives them a lower rate. But again, all this does is scream to you that 30-year mortgage rates have to drop, that they're unusually out of sync with historical proportional differences between the bonds that they track. So I want to stop with rates. I'm glad we could talk about it more until the end of the day. But look, rates are going to come down. Rates are, and regardless of that, rates today are still near historic lows. When they come down to 5 to 5.5 range, all I want to tell you guys is, whenever that happens, next spring, next summer, you're going to see a big pop in demand. But what's unique about this market is we still don't have units, right? This is from Building Magazine in September, but it just shows new research reveals America is short more than 5 million homes. They know this because they know household formation, and then they know how many units are needed. In fact, this is a piece from the Public Policy Institute. They're a think tank in Washington. You'll see the source is Census Bureau data and HUD data, but all they're looking at is a structural undersupply of housing units in the marketplace. Now, look at the timeline here, guys. This goes back to 1939 or before. The only time we've had less housing supply on the market. Now, this is units to own or rent. The blue bars, the dark blue is 1 unit detached. There's 1 unit attached. There's 2 to 4s. There's 5 to 19. That's apartment buildings, 20 plus units, and mobile homes. It's everything. It's all the homes that are available to live in the United States. It's available right now on the marketplace. We haven't had this low a supply of inventory since the period of 1940 to 1949. This is why there's no chance of repeating any kind of recession environment you guys may think is going to repeat itself. It just ain't going to happen. In fact, this is from Trading Economics. I pulled this morning off of their site. Trading Economics is a great research. These two slides, data slides, tell the same thing, but a reporter would show them differently. This is just looking at 1 year of homes for sale in the United States. This is current listed inventory in the United States. And as you can see, homes for sale went up from January of 22 through the summer. Now, it's now declining because everything you real estate agents know on this call. In the winter, people just take their homes off the market, get through the holidays, then you put it on as a new listing, right? I'm not saying you all do that, but we know that's what happens because there's just not a lot of activity in the winter. So don't look at the September line. But what reporters have been saying is, listings, homes for sale is increasing as demand shrinks. Well, that's just a 1 year perspective. This slide on the left is the same slide. It's homes for sale in the United States, the exact same number as you see on the top chart on the left, where it ends. But this is going back to 1980. We haven't had this low of an inventory of homes for sale in the marketplace since before I began my career 4 decades ago. This is an outrageous supply shortfall that's going to give us a double whammy because of this. Now, Some of you Fairway folks have seen this, but you have to show it because it's in current presentations. This is nothing more than demographics. This is the population of the United States by age. You can see the source at the bottom is the Census Bureau. That's the data source. Moody's Analytics is the economics team that did this chart. Mark Zandi is the chief economist for Moody's Analytics, probably the most renowned economist in the United States, period. But he did a presentation about the economy, and all he said is when it came to housing, he had a bunch of slides, and then this one, demographics are a tailwind. And all he showed is the current population. You see it's 2022 by age. The peak year for first-time home buyers in the United States is age 34. That's why he circled those bars, those what we call cohorts, but those ages there. And if you look at age 34, go to the left, age 33, 32, 31, 20, 29, 28, 27, 26, all the way back for a decade, every line, every cohort is bigger than age 34. Now, I want to remind you one more time, the peak year, the median year for first-time home buyers in the United States is age 34. You've got right now the opportunity as you sit here on the front doorsteps of the biggest demand, the biggest boom in home buying demand that will have ever happened in the history of this country. Now, the baby boom was big. That's those green bars over there on the right. That was a big generation, but the millennials are just flat out bigger. It's a bigger generation. 69 million baby boomers, 73 million millennials, and the bulk of them are just entering their peak first-time home buying year. And each year, we're going to even have more of them coming at us. This is the same slide done by the Public Policy Institute. Same source, the US Census Bureau, but they even showed it. If you look at the two arrows on top, on the right and left of those orange bars, median age for first-time home buyers is age 34. That's not a guess, guys. That's a Federal Reserve. The New York Fed publishes this data point. They track it. The median age for first-time home buyers is age 34. And by the way, the median age for moving out of your parents' home is age 26. You know that through IRS documents because that's when you're officially emancipated, the median of moving out. But if you look through, if you look at the median age for first-time home buyers, that orange bar on the far right of the orange bars, every year younger than that, even going back to that age 26 bar, frankly, the 25 bar, the 24 bar are equal or bigger than the current age 34-year-olds. Now, why should this be the best information that you could possibly have? Because all it says is to me is two things. One is if you think 20 and 21 were big, I promise you, look at the next 5 to 10 years ahead. They're going to be bigger for purchases. 2021 were huge mortgage years for loan officers, but in terms of purchase activity, aside from the lull in the first part of next year because of 7% rates and scared home buyers because CNBC is scaring them away, all the rest of it says you're on the front doorsteps of the biggest cycle of demand for home ownership that will ever have hit this country in history, bigger than the baby boom generation when they started buying in 1980. And these are two different economic slides from two different presentations. And by the way, the headline of the Public Policy Institute slide says millions of potential home buyers will age into their prime home buying age in coming years. Don't worry, I'm almost there. I'm almost there, guys. Just bear with me for 3 more slides. We're only at the half hour. So I also don't want anybody to forget the fundamentals of why owning a home blows away any other excuse for doing something with your money. People who say I'd rather put it in the market just don't understand leveraged investing. Owning a home is using other people's money, right? You buy a $400,000 home, which is roughly the median sales price of a home in the US today. You get a 90 LTV loan. That means you're putting $40,000 down. If that home only appreciates 2% per year on average for perpetuity, that's $8,000 a year. It actually increases because the home keeps going up in value, but it's $8,000 a year in that first year. $8,000 on your $40,000 investment is a 20% return. That's not funny money. That's real money. and it only compounds with each successor year. The average appreciation rate over the last 3 decades has been 3.6%. That's national. But let's just use 2 and show that return. You can't do this with other investing because this is leveraged investing. You earn the appreciation is an investment return on your $40,000 down payment, but it's earned on the full value of that property. And it's a rare opportunity that the average consumer can get that. But forget appreciation for a second. Go to the other 2 things. Mortgage interest deduction. On that same deal, suppose it's a 360 loan. Remember, it's 10% down on a $400,000 sales price. The rate's 7%. Your principal and interest is $23.95. In year 1, that's $25,000 in interest you'll pay on that mortgage. If you're in a 30% tax bracket, which is approximately accurate for what this homeowner would be in, that's $7,500. You get to deduct. That's off your taxes. That's $627 a month. That is a rare protection that you don't get with any other investment. I did a net P&I because I wanted to reduce the $627 a month off that $23.95. That turns into $17.68. And then I ran it back into my calculator for an equivalent rate, and it came out to 4.25 on the net principal and interest payment. Now you still have to make the full payment, but at the end of the year, you get this money back. So it's still a net kind of way of looking at it. The reason why I do this is people say, well, I'm going to put my money in the stock market. Well, in the stock market, not only do you not get mortgage interest deduction, nor do you get leveraged investment returns, you have to pay capital gains on your investment. And with a home, you actually get tax deduction on your investment, not capital gains. It's the entire opposite scenario. So forget the $8,000 on 2% appreciation. Forget the $7,500 back on the 30% tax bracket. Just amortization. Rent, you're paying someone else's mortgage. If you own, just after 5 years, you paid down that balance by $21,000. I mean, this is wealth creation that you get to create for yourself over time. And so these are fundamentals of home price of home ownership that can't be denied. Okay, rounding the final challenge here of putting together this complex discussion about why rates are near historic lows, but even good to go back a little lower. Why you're on the forefront of the best home buying demand that we will have ever seen in the history of the United States. Why inventory is just a massive problem that we haven't seen since the 1940s and isn't going to be resolved anytime too soon, which will keep upward pressure on prices. But then finally, I want to go through this other argument. This is all the same slide. It's from Trading Economics. This is what Diana Olick from CNBC publishes. Home prices dropped as of the last report, right? And so you see from May to September on a national scale, we've seen home price declines. That is just completely out of scope. In fact, if you look at just the last decade, we've seen home price appreciation rise. If you look at home price appreciation since 1970, home values have only gone up. So to be clear, this is the median sales price of single-family detached homes sold in the United States since 1968. This takes you all the way forward. Home values have only gone up. The only sharp decline we saw was the Great Recession of 2008, which was a truly unique phenomenon built on terrible demographics and terrible credit offerings from lenders in terms of no-doc, NEGAM, 100% financing, fog the mirror kind of lending that went on. But even beyond that, the market recovered dramatically. Home ownership investing has been the one surefire thing that Americans have made money doing. And the only problem I worry about today is some people are going to sit on the sidelines, they're going to bet on the market. I think that's ludicrous when you're sitting at a time when this may be the greatest opportunity. Final thought. This is from the Federal Reserve Survey of Consumer Finances. And I built this off of the Federal Reserve's website. All I queried was net worth and housing status. And I asked to display owner and renters. So this shows median net worth for owners or renters in the United States going back to 1989. The blue line is ownership. The green line along the bottom is renters. Renters do not build wealth. The only way to build wealth in America, this is median net worth, total net worth, just simply by housing status. Again, the blue line is people who are homeowners. The green line is people who are renters. The single biggest wealth creator in this country, proven by the Federal Reserve through multiple ways of looking at it, is through home ownership. It's not just this slide. This is from the Public Policy Institute on a presentation they gave. You'll see at the bottom, the survey, it's from the Survey of Consumer Finances. And all they looked at was the housing share of median net worth by income. And so when you look at income brackets along the way, orange is home ownership, green is renter. This is total median net worth. The blue sections are other investments. One thing that people don't realize is very few American homeowners are in the stock market. Very few first-time home buyers are in the stock market. Yeah, maybe a little in their 401k, but as you know, they don't even max out their 401k. Their ownership, if they're lucky, is in their home. And so if you take the income bracket of 74,000 to 127,000, which can be oftentimes your typical first-time home buyer, the wealth differential is 6 times being an owner versus being a renter. And so it's just a remarkable differential that public policy analysts know. Just take it another way. This is from, if you look at the bottom, the State of the Nation's Housing 2022. This is published by Harvard University, the Joint Center for Housing Studies. You can see the source, JCHS tabulations of the Federal Reserve Board's Survey of Consumer Finances. Now they headline this slide in their publication of this year, saying that even if they own homes, Black and Hispanic households have significantly less wealth than white homeowners. Yes, that's true. We all know that, we have a centuries-old challenge to overcome in this country related to disparity and the ability to build wealth. They didn't even pass the Civil Rights Act until I was 7 years old in this country. So that's just part of why policymakers are trying to do as much as they can to come up with programs to put more African Americans and Hispanics into home ownership. And why is that? Because as this Harvard slide shows, it says, I don't care if you're white, Asian, Hispanic, African American. If you own a home, which is the orange bar, you're going to build wealth. Don't mistake, the blue bars aren't renters. The little red slivers are. Those are rental net worth. The blue bars are combined net worth for renters and owners across ethnicities. So all this tells you is the reason why the current presidential administration is trying to do more through the Department of Housing to promote opportunities for first-time homebuyers. It's why the GSEs and Sandra Thompson, the head of their regulator, made policy announcements at the Mortgage Bankers Conference last week around changing pricing for some first-time homebuyers, because they know that'll help African Americans and Hispanics get into homes. And if public policymakers are trying to get more Hispanics and African Americans into home ownership, doesn't that say everybody should get into home ownership? Of course it does. And the only thing that worries me as we look at all of these slides is some, pardon my French, uneducated consumers are going to sit on the sidelines being freaked out by some local newspaper that's not really, doesn't have the analytic capabilities to understand market conditions, and convince them not to buy. And they're going to think they're going to bet the market, just like they bet the Bitcoin market, just like they bet the .com market. They're going to bet the housing market. And honestly, that's just a loser's bet. I'm going to skip this slide. This is a big forecast slide. All I will tell you is this forecast is similar to 4 or 5 other economic forecasts I have. Purchase activity, guys, is only going to rise for the next several years, other than a big part of 2023, which is why 23 and 22 are going to be about the same size for overall purchase mortgage activity. But if we look at 24 and 25, it begins to increase pretty significantly and will continue on. And why does every economist know this? The same reason every financial writer knows this. It's because the demographics of demand are going to be enormous and we have no supply. So I'm going to end you with a couple of slides, this and one other, on just newspaper articles, but this isn't from like the Boston Globe or the Denver Post or USA Today. It's not Diana Olick from CNBC, who, by the way, doesn't have a PhD. I don't even think she has a master's in business or finance, yet she convinces people to be afraid. This particular one is from MarketWatch. It was just published on September 14th. Connor Sense, the writer. Connor's a PhD economist. I read all his stuff. And all he said is home buyers might as well take the plunge. Affordability isn't going to get any better at shrinking inventories, and sure, prices will rise. And then it says, even if mortgage rates eventually fall. Now, that's a weird statement. I'm not going to explain his economic theory, but his theory is some people will say if rates fall, that means we're in recession, and therefore home prices will drop. He's saying the opposite. He goes, affordability isn't going to get any better, even if rates do fall. Rate prices are still going to go up because he knows the rules of supply and demand. Okay, bear with me on these headlines. These aren't from your typical mom and pop writer. This is from Wharton, the business school where President Trump went to college and a whole bunch of other business leaders in this country went to college for their master's degrees. This is from the chair of the finance department at Wharton. And it's an article written on September 6th of this year, why the housing market is not in recession. Guess what he says in his story that I just told you? Everything the same. He talked about demographics. He talked about the demographics wave coming at us. He talked about inventory shortages. He went on a lot further about home builders not overly building, creating excessive inventory. And he talked about a belief on where the economy is going to end up, which is still going to be a pretty healthy economy. I mean, it's so strong, the Fed can't slow it down. So that's kind of where we are. This is from The Economist. The Economist, this is a publication that is so nerdy that most people don't even read it. And this is from earlier this year, but millennial demand helps stoke the housing boom. What does he talk about in his article? The same thing I showed you. I've already given you the entire theory that these writers are writing up. This is John Reed. John writes for Time, but he's a really good economics writer. So I used his piece he just put out in early August. Waiting on the housing market to crash. Don't experts say, here's how today's market is different from the Great Recession housing bubble. And then finally, from Barron's, another just pure financial publication, millennials will drive home prices up for years to come. Now, I don't need to tell you what's in each of those stories or show you the articles because I just walked you through it. Everything they argue is in the slides I just walked you through. And yes, it's a little complicated to understand yield curves and understand why the spread on 30 years over 10 years on mortgages is ridiculously high, and that's why mortgages will come down. And it's even reinforced by the inverted yield curve of the 10-year and the 2-year. But if you can understand just the basic elements of this, and then understand the demographics and that picture, and the inventory history going back to the 1940s, where we haven't had such a low inventory, it's a really good story to tell. Okay, I'm literally done. After this is just my closing slide. This is the same slide you've seen before, right? You saw that demographic slide. I'm just showing it to you because this was presented by an economics team at the Mortgage Bankers Annual Conference in Nashville, Tennessee last week. And so, this same group of economists showed the same thing I'm showing. They showed the demographic demand that's coming our way. But this is really important for you real estate agents. And I just want to have you look at the right side of this thing. If you look at the home ownership by age, now the gray line at the bottom are people under the age of 35. People under the age of 35. Remember, the median year for first-time homeowners is age 34. This is basically people under that age. The home ownership rate is dismal. It's in the 40s. That's why we had no demand during the Great Recession. We just didn't have enough Generation Xers. It was too small a generation. They couldn't provide the demand that the millennials are bringing to us. But then look at the yellow line just above it. That's the next tier up. That's age 35 to 44. Look what happens to home ownership rates the moment you get above age 35. It leapfrogs. This is just the same story that these economists said that should tell you, gang, you are sitting on the front doorsteps of the biggest boom in demand for home ownership that we've ever seen in history. And that home ownership rate is going to leap up just like it has done going back for the last 20 years, as this slide shows, from 2022 to 2002. It's undeniable data. And the only way you can argue against this is to give me some subjective, I'm not sure I buy this, because all I'm showing you is market data and economic information. So finally, I want to leave you with this closing point. I think this market is so hard right now because we're being pummeled by bad media and people who don't really understand the data that's building this market. And so this is like a cup half full, cup half empty kind of scenario. And I believe that the people who take the cup half full approach are going to create opportunity this winter. So let's review. The market's going to slow, but it's still going to remain above the previous decade. Remember, I showed you that? The total mortgage demand is going to remain well above anything we saw going back to 2008, actually the last 14 years. The mortgage industry is right sizing. I think for realtors and home builders, that creates risk for you. Make sure that you're not with some public company that wants to exit the mortgage business. Wells Fargo announced they're going to back out of the business, but we're seeing a lot of other in the independent mortgage banker space because I believe because they're Wall Street owned, et cetera. But nevertheless, for you loan officers, the industry is right sizing. And with the kind of volumes we're going to see over the next few years, you've got some really good years to come. Rates are going to drop next year. I believe they'll be in the mid fives by year end next year. They might go higher between now and the end of the first quarter. They might go higher because nobody wants to buy mortgage-backed securities. So we still have a supply-demand imbalance. So that spread over the 10-year could even widen further as just the current market environment continues to move forward because nobody wants those loans that are likely to prepay, and that's going to push yields up for a few months. But make no mistake about it, this market is going to start right-sizing in terms of rates, and we'll be in the mid fives. Great opportunity to refinance anybody who took today's rates, as well as put new buyers into home purchases. Demographics and supply, guys, you cannot argue against this unique opportunity. And I want to tag team that with the next bullet point. I believe right now we're on the best, literally forefront of buying opportunity this winter that we may see for the next 5 years. Why? Because we're in a lull. People are worried. Home sellers are worried. And that may motivate them, real estate agents, but that may motivate them to bargain. It may motivate them to pay for a buy down and advertise a home with a starting rate of 6 or 5 or something in between that, depending on what the buy down you're willing to promote. And that could bring buyers out in the marketplace. But I think for home buyers, just the true reality that home prices don't go down, rates are only going to improve, and that's going to bring more demand out, that the demographics of demand are really outrageous. It's an unforeseen, never happened before in this history of this country that's coming our way. And the supply problem is ginormous, meaning no matter what happens to home values, I have very limited downside risk, but I got huge upside risk. And finally, look, risks always exist in our business. The question is how you respond to them. And I think using information without conjecture, I want to show you some data done by a true economist that may give you a reason to think about taking advantage of this winter when other people aren't in the market, so you can buy your dream home, bargain a little for it, and then not have to worry about this going forward. And then finally, I really think our business is about practicing optimism. And I think that comes from not getting dragged into the negativity of, I think, prognosticators who really don't know what the hell they're talking about, pardon my French. I think we have too many people who are scaring not just home buyers. I think they're scaring real estate agents. I think they're scaring new home builder salespeople, financial planners. I think they're scaring loan officers and convincing them that this is somehow, not the time to be in this market. And my answer to you personally is, I just use data. And to me, the data says just the opposite. To me, the data says everything I just told you, which is this is a great time to be in the business. harder for loan officers right now, but it's going to right size. Margins will return. Rates will come down. Home buyers are coming at us nonstop for the next decade. There is no inventory. So home prices are only going to go up. That's a problem as well. I know you real estate agents, but it's a great story. You're on mute, Jake.
Question and comment. What we learned in the 80s, and you say, why do you keep going back to that? We could not do a loan unless there was a deal for the consumer. You say, what does that mean? Consumers are the same. They want, what's their payment? What's their cash out of pocket closed of escrow? That's the two things they're concerned about. When you do a 2-1 buy down, if you put another $1,000 down, that changes your payment $5 or $6 per thousand. But a 2-1 buy down drastically changes the payment for the buyer. Instead of lowering your price as a seller, you can use the 2-1 buy down, which is roughly about 2.65% of the loan balance. The seller can pay for that instead of lowering the price. The point is, this is a great time for originators to talk to agents about how the financing can help sell properties. A 2-1 buy down gets deep enough, a 1 buy down gets deep enough that it gets the buyer interested. And that's really what the buyer wants, is they want a deal. They want to know what their payment is and want cash out of pocket, closed escrow. Keep in mind, as we as a company, starting in 84, we've done this discipline of making sure the money's at closing the day before closing. 75% of our closings for purchase deals, the money's there the day before. David, did you find, I said there's a question, did you find in the 80s that when you're working with people, if we did 10 loans, I would guess most of those were buy downs because nobody wants a fixed rate at 13.5%. So everybody wants a deal. Did you find that to be true? You were in Denver, I was in Phoenix. What was your
Yes. Yeah, of course we did. No, we never did a loan. I never did a fixed rate at 14.5 when they were 14.5. I did buy downs, or back then we had graduated payment programs. By the way, I hate to do this. Shout out to the JLC team. It's my sister-in-law, she's on that team. But the real estate team in Washington. But look, even, think about that, Steve. The buy down is truly valuable. Everybody wants to own a home. People want to own their home. They don't want to rent. They want to own their home. Especially if they're in that peak home buying year, they're building families, they've got careers, they want the home. The only reason they're not doing it, gang, is they're being scared away by rates and stories about what may happen to home prices. The home price thing you can overcome, I believe, with some of the data I shared with you, but the rates you can overcome by offering not 7, but 6, or if you're willing to do a 2-1, 5, then 6. And then you can refinance them out of there. The average American salary increase in the United States for the last 22 years has been 4.8%. That's the average. So even if you're stretching right now and you're able to get that buy down, your salary is going to be increasing over time, making that mortgage ever more affordable each year you're in it. And even if it does adjust up the 1% next year, which is about a 5% increase in payment, your salary will keep track with that, at least if you look at national averages. And so, I think we've got to learn to be creative. And Steve, that's what we did in the 80s. We couldn't sell fixed rate mortgages at 16 or 15 or 14, whatever they were. We did 3-2-1 buy downs. That was even more common. 2-1-1s, 2-1s sometimes. And that was a way.
Yeah, the builder stuff is 3-2-1 all day long. I mean, obviously with some of these goofy, stupid mortgage rules, there's QM, there's certain, depending on the LTV, how much people are putting down. But this is the time, folks, that it is important that you have a loan person that you spend some time with, so you understand how you can use this stuff to help your sellers. Because the sellers understand what that can be done. The buyer, payment and out of pocket, that's all they care about.
The streamline. There's some really good points in here. Look, factor and interest deduction. Remember, I talked about that that's why I think the core values of MID and leveraged investing and amortization are really incredible. One says you cite historical patterns as a reason for confidence, but then go on frequently talk about anomalies compared to historicals. No, I'm not talking about anomalies compared to historicals. Yeah, I'm talking about historical patterns, I believe, are what we should look at as reference points to give us confidence in future markets. Historical patterns in Fed funds rates say there's usually a recession after a Fed funds hike. In fact, there always is, and then rates subside. That historical pattern I believe in. Historical patterns say that 30-year fixed rates are traditionally 150 basis points over to 200 basis points. Over the 10-year, this is an anomaly right now. Why is it an anomaly? If any of you did any advanced degrees in economics, you'll remember discussions around technicals and fundamentals. Fundamentals are what should give you confidence about the data that I shared with you today. The technicals are what's driving the current market anomalies because we have these weird duration bets. And you guys, if you were in my world, in capital markets that I lived for years and years at Freddie Mac and elsewhere, we talk about DV01s and convexity and things of this sort. It's really, it's what's driving all of this rate oddity that's occurring in 30-year mortgages right now. So yes, this is an anomaly. It's a technical. It's not a fundamental. And technicals go away after a period of time. I'm not going to go back and show those other slides, but we've had inverted yield curves on the 10 and 2-year before, but always in a similar environment. It always portended a future drop in mortgages to come. And so, yeah, so I mean, I think that was a good point, but I think it was perhaps a slight misunderstanding of how I look at this market. Someone asked about home prices over the next 6 months. The challenge is home prices are going to slow, whether they slow to 0, low single digits. Most economists are somewhere in the 2 to 4% appreciation range. That's a national number. And all that means is we're going to have some markets where it's more than that, and we're going to have some markets that are less than that. And that means that some areas home prices will go down. I don't think your buyers should care, and here's why. The opportunity to buy in and get some bargaining power to get in the home right now, rather than when they start catching on fire again late next year, is going to give you some opportunity. And no matter what happens with home prices, as we've seen in that one slide I showed you, that takes you all the way back to the history of studying home price values in the United States, home prices always come up and they always recover after downturns. So the point here for me is don't bet on markets. I really believe that people who bet on home purchase markets are just, think they're really good guessers. And they're same as my friends who were in Bitcoin. I have a good friend who lost everything she had in the dot-com boom. I just don't bet markets. I really don't. I've always been in home purchases. I never get out. And I think that's just a really important opportunity to talk about. And Steve, this is a rare chance to team up and partner with a good loan officer. Obviously, I'm here for Fairway. It's not the only great mortgage company right now in this country, I don't think, but I think it's one of a number of mortgage companies that you can trust that will be a steady, forthright partner, over the long term while we're seeing all that's going on. The advantage of an LO is they can do some of this number pulling for you. They can help run MIDs and home price appreciation and show it as leverage investment returns, and they can run equivalent rate scenarios for you. They could probably help walk through some of these slides because it's more data. And some of you real estate agents are really good at this. Others might want some help, just like I would never want to be one selling a home. I would fail at it, which Lara Clark here, who's making comments, knows all too well. And that's why I always use a real estate agent, because no matter what experience I've had in finance, I don't know the housing market. And so in the end of the day, my only assumption here is let's stop worrying about where rates are right now and where home prices are. Look at the fundamentals, not the technicals. And that will tell you home prices always go up. The demographics are real, irrefutable. I showed you 3 different economic views of that damn data. And supply is at historic lows, never seen since 1945 to 1949, that period in America. It's just a great time to be in the business if you can go out there and practice optimism enthusiastically and give it a shot. The worst that'll happen is people say, I still want to wait. And that's fine. I think most will say that right now. We're at the hours, Steve. I don't want to overstep them.
Two things, these slides will get to our people and then our people will get them to you folks if you're interested. Number one. Number two, somebody asked about 3-2-1 buy down. It's roughly 5.6% of the loan balance. And all the buy down is what the note rate is and compared to what the buy down rate is. It's real simple. It's not complicated, but it does need to be explained. It takes 15 minutes, all in to kind of share with you how it works and how you can use it to help sell homes. Instead of lowering the price, you can have the seller pay the buy down cost. The seller net, buyer only cares about the payment and cash to close. So it's just a discipline. It's what you have to do if you want to use the financing to help. David, you've been great as usual. We're grateful for the help and the support. And this thing is blowing up. Everybody's excited about what you shared. So we are indebted to you always. Thank you. Thank you. Thank you. Everybody have a great day.